Hello, I'm Hallam-Baker and I'm talking about Bitcoin again. And part of the reason I've come back to Bitcoin is, well, the response to my last video, which was, I can go through your arguments point by point from this perspective and shoot each one down. Well, why didn't you do that instead of saying that you could? I mean, I've got a good argument against you, but I'm not going to make it. It's not really a very strong argument. And really neither are any of the other arguments I'm seeing from the Bitcoin camp. It's just a repetition of the original claim that Bitcoin is wonderful and it's new and it's growing, therefore it's the future. But they're just not willing to be serious about money, which is a really serious topic. I've been doing financial crypto now for 20 years. And if you can't explain what's going on, well, who's going to trust you? And of course, the other reason I'm making one is that yesterday, the largest Bitcoin exchange, or what used to be the largest until it suddenly shut down and stopped offering withdrawals, has now disappeared from the net altogether. The website is down, the Twitter feed is down, and well, the people behind it are nowhere to be found, which is probably quite wise given the type of people who are probably after them, looking for the 745,000 Bitcoin that are now alleged to be missing, which at Bitcoin valuations is alleged to be $350 million. Oh, I think that with $1/3 of a billion missing, there'll be a lot of people looking for those guys. In the immediate aftermath, the Bitcoin price fell to $419. But of course, none of this matters. According to Mt. Gox, well, with the profit, a meticulous analysis will be made over the coming years to clean the Bitcoin balance sheet while running the exchange and generating revenue to pay back the stakeholders. In other words, these guys think that people are going to invest more money and use them as an exchange for the next few years while they pay back the people who've already lost that 350 million. I don't think it works that way. In fact, here's what I think is going to happen to Mt. Gox. It's going to become a verb. And it's a verb meaning to steal money in a complicated technology-based financial fraud. And to use it in a sentence, she goxed over $1 million with her get-rich-quick scheme before she was arrested. And if you look on the Bitcoin forums, arrest is pretty much the nicest thing anybody's suggesting doing to the Mt. Gox folk at this point. But that's just one bank. According to the Bitcoin community, this tragic violation of the trust of users of Mt. Gox was the result of one company's abhorrent actions and does not reflect the resilience or value of Bitcoin and the digital currency industry. Only it does, because one of the things that we know about bank runs, and there's a 500-year history of bank runs. As soon as they invented paper money, we started to have bank runs. And the thing about bank runs is that they are infectious. If there's one bad bank, people start taking their money out of the good ones as well. And when the banking crash happened in the 1920s, it was all the banks that were vulnerable until the federal government stepped in and said they would be the lender of last resort and prop up the banking industry. That's what had to happen in 2008, or else it would have been bye-bye to the banking industry. Banking is about trust, and you can't lose one of your largest banks without the trust in the whole system going. So the reality of Bitcoin is there's a run in progress. They may be able to stop this one, but that's probably going to be because it's so difficult to get your money out physically. People can't stampede for the exits because there simply isn't enough liquidity in the system to pay everybody out. But beyond that, Bitcoin is technically stupid and it's economically stupid. And it's just time to take the gloves off and stop shilly-shallying and tell it how it is. It's stupidity. Well, what's Bitcoin anyway? As in any currency system, you have two parts. You have a representation of value and you have a transfer system. The very first money systems, the representation of value was something with intrinsic worth, something like wheat or in the early American colonies, they used tobacco as money. But of course, the problem with things that have intrinsic value like food is they tend to be rather bulky. So fairly soon people started to see the value of using metals, and in particular precious metals, gold and silver, for money. One of the reasons that gold and silver were so valuable was because they were scarce. There's not much silver or gold in the economy. And the scarcity value is really what gives precious metals their premium over their value as jewellery. Same thing for diamonds, and for something like a cowrie shell, well, it's got really no intrinsic worth at all. But because it is scarce in Africa, far away from the islands where they're found, it has scarcity value and can be used in currency in one place, even though it's plentiful in another. The other thing that you need for a money system is a means of transfer. And in Bitcoin, this is the blockchain that everybody talks about. Blockchain, 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 blockchain. 20 years ago, when we had the first e-currency bubble, they were muttering bearer transactions, that's what it's got. Bearer gold, that's what makes it special. You know, nothing's really changed. It's just some technical tweak. I'll get to that in a moment what it is, but what it is doesn't really matter, because all these people are looking for is something that allows them to believe in what's really quite ridiculous. So if we've got a physical asset like gold, we simply hand it over. But most money today is electronic money. This is one of the silliest things about Bitcoin. The idea that they've invented electronic money. We've had electronic money since the 1950s, when IBM started making computer systems and they were used in the banking industries. Visa is electronic money. MasterCard is electronic money. Every dollar that's in Bank of America is electronic money. Bitcoin just really isn't that different. The other thing, but you do need to have a mechanism of transfer, and for electronic money, that is some sort of ledger system that shows that the money has transferred from one person to another. The way that Bitcoin creates scarcity is through mining. And this is, what they do is that they have a series of problems that are difficult to solve. And the problems are designed so that somebody will solve this problem about once every 10 minutes. And when they solve that problem, they're given a reward. That reward is a chunk of block of bitchain. Sorry, a chunk of Bitcoin. And each time they solve a problem, they get 25 Bitcoins given to them. The precise nature of the problem doesn't really matter. They're using a system called a one-way function. It's something that's easy to calculate in one way, but enormously hard to calculate in the other. And what they're doing to make it possible to solve these problems is that they're saying, okay, you don't have to give an exact solution, you just need to be within this distance of the correct solution. So at the moment, all those miners are competing to be the first person to solve this puzzle. If they solve it, they get 25 Bitcoin, which at the moment are purportedly worth about $500 each. So if this is happening 10 times every 10 minutes, that's 60 solutions an hour. Okay, multiply by a day, that's about $2 million in Bitcoin being minted. Okay, where's all that money coming from? Well, I don't know where it's coming from. In fact, it's not really coming from anywhere. But I know where some of it is going, and that is paying for the mining rigs themselves. In that, if you've got $2 million a day being invented, there's going to be people spending money to get it. And since it's an open free market, well, there are people who are investing money in equipment. $70 million worth of Bitcoin, specialized Bitcoin mining equipment was sold last year apparently. And about $10 million a month is being spent on electricity to mine Bitcoin. They're using as much electricity as the island of Cyprus, a nation state. So this is pretty serious stuff. This is just one of the Bitcoin data centers. It's run by a company called Butterfly Labs, and you can rent Bitcoin mining time on this rig. Yes. So people are putting real money into mining these coins. Whether the coins are worth anything or not is debatable, but they're certainly spending money to create them. The other part of Bitcoin is how do they transfer value? And the first part of that is just a standard transaction log. Only because of the design of Bitcoin, it's similar to your bank statement that comes every month and tells you how much money you put into and out of your bank account. But instead of tracking you, the holder of the account, in Bitcoin, the transaction chain is following the money. It's following the coins, where they started from, where they went to, when they were split up and all that stuff. So every transaction ends up in this transaction log. And this is a public item. So you can see where the money was transferred to and from. You don't know who is behind the accounts, you just know this wallet identifier, which has to do with public key cryptography. But so you don't know the identity of the wallet holder, but you can see where all the money is going and who is moving from this to that. So you can actually uncover quite a bit of information, which might be why, despite the alleged use for the drug, well, it's no longer alleged, it's real, despite the fact that Bitcoin is being used for all those drug deals, this is probably why the authorities aren't in a desperate rush to shut it down. They can track what's going on. They don't know who is buying stuff or why, but they can see where money is moving from A to B. This is also a factor in the inflation of the Bitcoin price, because if you are invested in this Bitcoin ecology, well, you want to show that there's a lot of economic activity in Bitcoin. And so if you want to do that, well, you just take your money and you move it from one of your wallets to another, and you circle it and you churn it, and it really doesn't cost you any money at all, but it creates a large amount of bogus activity. As a result, we really have no evidence for more than a few $1 million of actual legitimate activity in Bitcoin. We don't know what the rest is. It could be lots of people buying drugs, it could be lots of people gambling, it could be just people sloshing it from one account to another to keep up the illusion that there's something real going on here. We don't know. Now, the thing about the transaction chain is, well, how do I know what the transaction chain is? And in a traditional electronic money system, there would be some authority that would sign the blockchain at sign the transaction chain at regular intervals, and then you know it's fixed in time fixed for all time. But Bitcoin is designed to be decentralized, so there isn't one authority that everybody has to trust to sign this log. How does it work instead? Well, what they do is that they connect the Bitcoin mining operation to the sealing of the transaction log, so that when Bitcoins are mined, that mining operation causes all the transactions that have been signed and already in the pending transaction log, they are finalized in the act of minting the coin. And there's some fancy cryptography, well, it's not even that fancy, but there's some cryptography going on that shows that this is happening. Now, there is an issue that can arise, though, that what happens if there are two different parts of the world where two people come up with a new block for the blockchain about the same time? Whose block wins? And here the answer is that the Bitcoin community will always take the longest blockchain that it can find, or rather the blockchain that has the most work in it. And so if two people come up with the same block more or less the same time and there's a collision, well, they'll wait a little while, different people will work on different parts of the blockchain until they reach a point where one chain is clearly longer than the other, at which point people are going to stop bothering to try and extend that old chain, and everybody converges on the longest chain, and that's going to be the one true authoritative one. And that is how Bitcoin transactions are settled. Or rather, that's the theory. There is a problem. You see, if one person could ever get to the point where they controlled more than half of the active capacity of Bitcoin mining, they can perform what's called the 51% attack, which means that it doesn't matter how long somebody else's blockchain is, I can create a longer one because I've got more capacity than them. And even though the rest, the 49%, can win in the short term, you know, they might get one block and the next block another. If I just keep at it for long enough, I'm eventually going to get ahead of them all. Why does that matter? Well, if they were just doing Bitcoin mining, it really probably wouldn't matter very much. But because they're using the blockchain to seal the transaction chains, that means that anybody who can perform a 51% attack can perform a double spending attack. They can unwind the transaction chain and now they can spend their money twice. So what they would do is they buy a car, they drive it out of the lot, and then they set their Bitcoin mining rigs to unwind the transaction. So it never happened. So one of the problems with Bitcoin is if you ever have a situation where one party or a group of parties acting in collusion can control a majority of the transaction log, they can essentially destroy the whole financial infrastructure. Which is probably why you're not going to want to replace the Federal Reserve with Bitcoin ever. But there's another problem here. And this is something that is a consequence of what happens when the price comes down. And this is actually an attack that was raised about 10 years ago when people first started talking about these things. Now, the 51% attack is acknowledged by the Bitcoin community. But what they don't acknowledge is that Bitcoin requires electricity to mine. It requires a lot of electricity, so people are only going to mine if the price is high enough. If the price of Bitcoin falls, well, either people will stop mining, in which case the blockchain stalls, or they have to reduce the difficulty of the problem so that enough miners will keep going to keep the system active. Why does that matter? Well, if you wind down the difficulty of the problem, you get to the Bitcoin mining squeeze. And to illustrate this, let's just take a hypothetical. Let's say that the Bitcoin price has got up to the point where one Bitcoin is worth $1,000. So knowing this, the Bitcoin miners are going to invest in hardware. And they are probably going to be fairly confident in making a profit on their investment if they can mine Bitcoin for $500 worth of electricity per Bitcoin on average. I mean, they're not going to spend that $500 and guarantee they get a coin, but if they're doing this all the day, they're going to get enough Bitcoins that they can make their $500 return on their overhead. And then the profit's enough to pay for their mining rigs and so on. So if the price of Bitcoin is higher than the cost of the electricity, or that mining capacity, all those data centers I showed you in the photograph are going to be 100% utilized. But what happens if the price drops? Well, if it drops to $500, well, mining becomes a break-even proposition at best. People might turn the rig on, they might turn it off. It doesn't make money for them either way. But if the price drops below the cost of the electricity, say it drops to $250, well, people are going to turn their rigs off because it's simply not worth mining. And so the blockchain will stall, Bitcoin commerce will stall until the difficulty of solving the problems has been reduced, at which point fewer people will start mining because the incentive is less. And so even though the problem is easier, it's still only going to be a break-even proposition for the miners. And here we get to the 51% attack again. See, the thing is that traditionally when the Bitcoiners are talking about the 51% attack, they say it's 51% of the Bitcoin mining capacity. That is false. All you need for 51% attack is to have 51% of the active Bitcoin mining capacity. Why does that matter? Well, if the price drops to $250, the Bitcoin, the utilization of that capacity is going to be no greater than 50%. So I can do a 51% attack using that capacity by only having 25% of it collude. Or that 50% that's sitting on the sidelines can come back in without telling anybody. And so the problem is, if there's ever a significant drop in the price of Bitcoin, the 51% attack dominates, and at some point somebody's going to realize that they can't make money from mining Bitcoin. The only way they can make a return is by unwinding transactions. And that's the point at, well, the fact that there are so many drug dealers, organized criminals and so on involved in the Bitcoin ecology makes it a certainty that one of them is going to take that route to getting their money back. Yeah. Dealing with organized crime is always bad news. But that's criminal! Well, yeah. And this is the point at which maybe you wish that you had some regulators involved and some government involvement to protect the interests of the people involved in Bitcoin. Regulators aren't there because governments just want to be a pain. Regulators are involved to stop criminals stealing people's money, like the problem that we all think happened at Gox. The other problem is Bitcoin is just nonsense from an economic point of view. And to illustrate that, let's imagine that you bought a camera costing $1,000 using Bitcoin on 1st of October 2012, when the price of Bitcoin was about $10 to 1 Bitcoin. Okay, so you paid your 100 Bitcoin, you've got your camera. But let's say you buy it on 12-month interest-free credit. After all, interest-free credit's a common thing in the real financial world. Can't do it in Bitcoin, can you? Well, actually you can't. Because if you had done that, by the time that that interest-free credit was due a year later, you have effectively shorted a stock that has gone from $10 to $1,000, and your debt that was worth the price of one camera is now worth the price of 100 cameras, $100,000, or 3-4 cars. This is called deflation. Nobody is going to spend Bitcoin because it's going to increase in value. So it's always going to be the economically smart thing to not spend money, which means that if you have an economy based on Bitcoin, it will instantly collapse because nobody will do any business. This is the cause of the Great Depression. And yes, it was too. So where does the Bitcoin price come from? Well, it's quite simple. It's simply supply and demand. And right now there are more buyers than sellers because, just like with every other bubble stock, buyers and miners are expecting the price to go up. So nobody wants to sell or spend their Bitcoin because they think they're going to make a 10-fold, 100-fold return on their money. So the market cap of Bitcoin is $7 billion. But if you look at the cash inflows into Bitcoin, it certainly isn't anywhere near 7 billion. That's not real money, that's fake. And when people try to run to the exits, it's going to be ugly. So, Bitcoin economics. You can't bank in Bitcoin because your money is going to be goxed. You can't borrow in Bitcoin. The credit risk is just too great. You are shorting a stock that can go to infinity. But if you can't borrow, nobody can lend. And you can't accept Bitcoin as payment because the 51% attack means that if you can't cash out that payment to a real currency quickly enough, somebody can unwind your transaction and double spend on you. So you can't bank, you can't borrow, and you can't use it as a payment system. But other than that, Bitcoin's the future of money. Thank you very much.